Ever wondered why your savings account isn't making you rich? You meticulously deposit your hard-earned money, watching the balance grow bit by bit. Yet financial freedom feels as distant as ever. The grand, solid bank buildings seem to promise security and prosperity. But beneath the surface, a different story unfolds. The flow of money isn't designed to work for you. It's designed to work for them. To understand why your savings aren't building real wealth, we need to pull back the curtain on how banks actually operate. It's a system built not for your financial growth, but for their own profitability. At the heart of a bank's business model lies a simple yet powerful concept: the interest rate spread. It's the gap between what they pay you and what they charge others. Imagine you deposit your money into a savings account, and the bank offers you a modest 1% interest rate as a reward for your trust. They don't just let that money sit in a vault. Instead, they turn around and lend that same money to someone else, perhaps for a mortgage, a car loan, or a business venture, at a much higher interest rate, say 7%. That 6% difference is the bank's core profit. Through this mechanism, your savings become the raw material for their lending machine, generating substantial returns for the bank while you receive only a fraction of the earnings. But the interest rate spread is only one part of the story. Banks have mastered the art of generating income through a labyrinth of fees and penalties. These charges often hide in the fine print of your account agreements. Think about it. Monthly account maintenance fees that slowly chip away at your balance, overdraft fees that penalize you heavily for a small miscalculation, and late payment penalties that compound your financial stress. Each of these fees, while seemingly small on its own, adds up to a massive revenue stream for the institution. Visually, it's like watching small icons of money being constantly siphoned from your account, a steady drain that counteracts the meager interest you earn. This fee-based income ensures that banks profit even when their lending activities are less robust, creating a reliable source of revenue directly from their customer base. Beyond basic accounts, the cycle of debt is where the profit model truly accelerates. Products like credit cards and personal loans are engineered to be incredibly lucrative for banks. They are often marketed as convenient tools for managing expenses or achieving life goals. But their high interest rates can easily trap consumers in a difficult-to-escape cycle. Picture a person running on a hamster wheel constructed from credit cards. They keep moving, making payments, but the debt remains stubbornly in place, perpetually generating interest income for the bank. This design isn't accidental. The minimum payment structure is calculated to keep you indebted for as long as possible, maximizing the total interest paid over the life of the loan. It's a system where the consumer's debt becomes the bank's most reliable asset. In the end, it's crucial to recognize the fundamental truth. A bank is a business, and its primary objective is to generate profit for its shareholders, not to make its depositors wealthy. Your savings account is a tool for liquidity and safety, not a vehicle for building significant wealth. The system is structured to leverage your capital for their gain. True financial empowerment doesn't come from passively saving in a bank account. It comes from understanding these systems and actively seeking out knowledge. To truly build wealth, you must look beyond traditional banking and pursue financial education, learning how to make your money work for you, not for someone else's bottom line.